Welcome to Book of the Day. I'm Jonathan, and this will be a continuing series where I read a book and then present what I find to be the most important things that we can take away from the book in question. I have read The Intelligent Investor, written by Benjamin Graham and published in 1949. And Graham, he was a British-born American economist, professor and investor. His investment philosophy tackles the subject of investor psychology, buy and hold investing, fundamental analysis, concentrated diversification, and buying within what he called a margin of safety. Warren Buffett, who is currently one of the most famous and successful investors, was also a student of his, and he describes The Intelligent Investor as the best book about investing ever written. So in short, the book covers Graham's philosophy when it comes to investing and what he thinks is a successful mindset when investing. So what are some golden nuggets of wisdom that we can extract from this book? I have picked out and divided things I learned into 4 different areas, which I think would capture the book's message and lessons to us readers. So, the first lesson is to analyze. We should always analyze before we buy anything, whether it be a stock or any kind of security really. Graham, he makes a clear distinction between investors and speculators. An investor takes a calculated risk according to his own estimates and best ability, whereas a speculator is just taking a blind bet on what he hopes will make him profitable. Graham says that we should try to look for discrepancies between the value of a business and its current market price. A direct quote from the book goes, "At some point in its life, almost every stock is a bargain, and at another time it will be expensive." So it goes without saying that you should try to value the asset you are buying. So if there is a difference between the market price and the intrinsic value of a company, you should, as an intelligent investor, try to exploit that in order to make you a profit. Hopefully, if you're right, the market will catch up and adjust the market price accordingly, and then you can sell for a profit. The second lesson from the book is that we should aspire for adequate returns on our investment rather than fantastic or unrealistic ones. In the long term, time will work in our favor, and we can reap the benefits of a steadily growing invested capital. So we should be realistic and patient and not chasing unrealistic ideas, hoping that we should double our money super fast. The third lesson from the book is to take measures to protect ourselves from serious losses. But how can you do this? Graham thinks that you should manage risk but not avoid it altogether. He speaks about diversifications in investments, so don't just own one stock or companies from one sector. He also speaks about investing within a margin of safety. This comes into the picture when you're trying to value a company. Say that you, after some analyzing, come up with a fair price of $100 per share for one particular stock. Then you can say that I will give myself a margin of safety to be wrong in my calculations, so I will buy the stock at $95 per share instead. How big this margin of safety is in your calculations, or how you go about implementing it, will be up to you to decide on, but it's a healthy practice to make use of when you invest. Another way to protect yourself from serious losses is by having emotional discipline. Make a plan and stick to it. The only time you're really losing money is when you sell lower than what you bought the stock for, but then again, it could go even lower. But if you value something, you should only consider the facts that affect the company's intrinsic value and not its current market price. So you need to remind yourself that what you do is as important as what you don't. And last lesson that I take away from this book is that we ought to know ourselves. Graham talks about 2 different kinds of investors in his book, the defensive investor and the enterprising investor. He doesn't say that one is better than the other, but it's good to know which one fits you better. The defensive investor cares about safety and the freedom from bother. This kind of investor will probably have returns that are more stable and more in tune with the overall market, and they don't have to be as active as the enterprising investor. The defensive investor would allocate more money into high-grade bonds and also more diversified assets overall. The enterprising investor, on the other hand, will share a similar base resembling that of the defensive investor, but he will also want a better than average market return. This, although, will require more commitment. Graham gives a few examples on how the enterprising investor would get better results. He might consider buying in low markets and selling in high markets. He might consider buying carefully chosen growth stocks, companies with room to grow. He might consider buying bargain issues of various types or buying into special situations in the market. So, in summary, we have gone over tips on how to be an intelligent investor according to Graham. And as an intelligent investor, we are realistic, we manage risk, we analyze before buying, and we know what kind of investor we are and we stick to our plan. So that's all for today's video. If you liked it, please subscribe and hit the like button. Hopefully I will see you again in the next video.